Russ, let's start right here. Your line. We expect interest rates to rise from these low levels. We think any backup in long-term rates will be contained given a still insatiable appetite for yield. How much of what we're seeing, Russ, is that? How much of it is actually worries about the future of this economy?
Good morning, Jonathan. So look, I do think that what you're seeing now is the unexpected uncertainty over the virus. We thought and we hoped this was behind us. Clearly, that's not the case, and this is why you've seen this modest pullback in yields. But again, it's worth highlighting, even a few weeks back when inflation was pushing up against 30-year highs, nominal GDP was pushing up against multi-decade highs, the 10-year was at 165. That's not something that would have made sense to us 2 or 3 years ago. And I think a lot of it does come back to this longer-term secular trend that has nothing to do with the near-term inflation outlook, nothing to do with the virus over the next few months. It really is about the fact that we've been in a low-yield world for decades. You've got an aging population. People need income. And when you see these backup in yields, it's incredible how quickly people jump on that and enter the fray. And that's likely to continue even in this current environment.
Russ, I'm honored to ask you this because not only is it global allocation, but it's you really thinking across assets as well. How important is the sector call into the new year versus the individual security call?
I think the sector call is going to be very important. Where you are in the sector always matters. But you think about the last year, you've seen days where the market is flat. And whether you're in the right sectors or the right style has made a huge difference in your performance. So you've got to get the stock pick right, but you've also got to think about what is the regime we're in? Are we going to see inflation continue to climb? Are we going to see growth decelerate? Those are going to influence whether we continue to see technology dominate, whether we go back to that value cyclical trade. So I do think it's going to matter a great deal, particularly in an environment in which the economy, while still very strong, and growing above trend is almost certain to decelerate in 2022.
Russ, we're giving narrative to all sorts of macro themes, and it's unclear whether this narrative is actually playing out in markets. Instead, people are saying it's positioning. It's people hunkering down, cashing out of their positions after a tremendous year if they were long equity, if they were long risk. What are you doing over the next couple of weeks as we head into 2022, given the uncertainty and given the lack of conviction right now of what next year will bring?
I think the short answer is we're sticking to our positions. We've had a portfolio for most of the year, really all of the year, that has been overweight equities. We're going to continue with that because we still think an environment of well above trend growth and very low rates is still positive for equities. We're underweight duration. Again, we don't think rates melt up, but we're not changing that. And, we're also sticking to what I would call a barbell approach on the equity side. I don't think this is the time to chase deep value. I don't think this is a time to go all in on early growth. It's really a matter of having high-quality cyclicals that are going to benefit from this recovery and sticking with some of the longer-term themes in technology, communications, healthcare that we think are still going to work into next year.
Why do you think the dollar is going to continue to strengthen if a lot of the rate hikes have already been priced in?
The dollar, I'm going to frame it slightly differently if I can. I think the dollar has become one of the last hedges that are really working in this environment. We all know that, the correlation between stocks and bonds have shifted, has been a problem this year, given that it's traded with risk, not against risk. What's happened with the dollar is that it's actually become fairly negatively correlated with stocks. And it sounds like, fairly geeky observation, but it's important because when you get these days when the market is getting hit on rate volatility, which has happened a lot more in the last 6 to 8 months, the dollar has generally worked as a hedge. So we've been maintaining an overweight to the dollar. We're going to keep that into 2022.